So good morning, everyone. Good morning, fellow participants. Good morning to the speakers for what promises to be, for me, a very interesting and educative, I think, 90 minutes on the important, very, very important issue of climate finance and climate transitions. The physical and transition risks associated with climate change and environmental sort of challenges, bodies, more generally, is sort of juxtaposed today with the need to actually increase at scale the finance available for, climate sustainable development and development transformations. This means that we have to work on two fronts. We have to try and understand risk, mitigate it, and at the same time provide finance to be able to deal with that risk and to also deal with the scaling up in finance that's required. This means a tough job, I think, for regulators, such as the Reserve Bank of India or the Bank of Indonesia, because while they have one mandate, which is to increase the outflows of finance through the financial system, and they have to worry about that in the context of macroeconomic and macroprudential stability anyway, you now have added on the sort of macroprudential dimension of climate risk, even when we are trying to find more money to make climate compatible investments. These things have been taken up now at the highest level. If you look at the chair's summary from the G20 finance ministers and central bank governors meeting last March, the first one in the G20 presidency, all the central banks in the G20 remain very strongly committed to achieving not just price stability, but also to dealing with the macroprudential and macroeconomic risks stemming from climate change and transition policies. So there is an appetite there for country-specific, I think, analytics to understand the challenge better and to confront the challenge to promote broadly the resilience of financial systems. And India's Ministry of Finance just led on a G20 paper, which has outlined some of the issues. This meeting is intended to respond to this demand for a discussion on priorities within the aegis of the G20. We are hoping that we will be able to explore priorities and steps to build the relevant capabilities of financial supervisors and regulations, understand the challenges, etc. And it's, I think, particularly propitious that this is happening in advance of the third meeting of the G20 finance ministers and central bank governors and the third Sustainable Finance Working Group. So without further ado, may I then welcome our participants, and I'm delighted to welcome Executive Director of the Reserve Bank of India, Saurav Sinha. RBI has just produced a rather excellent report, I must say, Mr. Sinha, on climate risk, and I must commend you for it. It lays out, it doesn't close any pathways, but it certainly provides us with an analytical framework in which to progress. So our Reserve Bank remains professionally committed. Even when they get new challenges, they're able to respond as usual in the best traditions of central banks, fast and competently. So we are really keen to hear from you. The floor is yours, Mr. Sinha.
Thank you so much, and very good day to everyone here. Delighted to be part of this roundtable. Dr. Rathin Roy, Ms. Neha Kumar, distinguished panelists and participants, ladies and gentlemen, thank you. Let me begin by complimenting the organizers. This roundtable provides us an opportunity to brainstorm on the road ahead on the critical issue of building sustainable finance capacities for emerging economies, even as the storm clouds of climate-related financial risks gather outside our windows. The fundamental principle of risk management is identification, measurement, monitoring, and management of risks. It is no different in case of climate risk. However, problems are unique in case of climate risk, as these risks materialize over a longer period of time, and there are issues relating to availability and quality of data, and the past is not a very good predictor of the future, hence difficult to be modeled. Nonetheless, the four guiding principles of risk management have to be followed in case of climate risk as well. And this is all the more reason why BCBS had come out with the principles for effective management and supervision of climate-related financial risks in June 2022. This contains 18 high-level principles, 12 of them providing banks with guidance on effective management of climate-related financial risks, while the other 6 provide guidance for the potential supervisors. The broad essence of these principles is that regardless of size, complexity, or business model, climate risk drivers can translate into traditional financial risks like credit, market, and operational risks. Banks should ensure that the risk management frameworks consider all material climate-related financial risks to which they are exposed. Banks should incorporate climate-related financial risks into their internal control frameworks. Banks should manage climate-related financial risks in a manner that is proportionate to the nature, scale, and complexity of their activities. And banks should seek to ensure that their internal reporting systems are capable of monitoring and producing timely information to ensure effective board and senior management decision-making. The biggest challenge, as has been acknowledged by everyone, is that of capacity building. There is a growing need to sensitize India's financial sector to the importance and benefits of green finance, with special emphasis on capacity building and creating awareness of climate risk and sustainable finance to tackle the challenges. And therefore, to give impetus to the same, a series of training programs, webinars, conferences, seminars, etc., are required to be organized by the regulated entities for their employees. A lot of work has been initiated in this area. India, as a part of its G20 presidency, has taken a lead, and the Sustainable Finance Working Group has identified capacity building as one of the priorities. The group would be developing a G20 Sustainable Finance Technical Assistance Action Plan based on the findings of a stock-taking exercise aimed at identifying technical assistance gaps and priority needs. Further, as you may be aware, the NGFS has, as part of its work program, set up a task force on capacity building and training with an objective of building on the various capacity building experiences developed so far, which will identify good practices on how central banks and supervisors can design and develop in-house training, capacity building strategy, map their training needs and supplies, and facilitate the upskilling of central bankers and supervisors. Likely, the FSI, which is a part of the BIS, has in its document Emerging Sound Practices on Supervisory Capacity Development, stated that sound capacity development underpins an effective system of financial supervision. A key observation from the survey on climate risk and sustainable finance undertaken by the Reserve Bank last year was that there was a growing need to sensitize India's financial sector to the importance and benefits of green finance. The discussion paper added that the Indian Banks Association may set up a working group on capacity building in this area to assess the training requirements. I'm glad to note that the IBA, the Indian Banks Association, has already set up a standing committee on ESG and under its aegis begun organizing knowledge sharing events and sessions for its member banks. It is heartening to note that the Indian Institute of Banking and Finance and the International Finance Corporation have jointly launched an e-learning certification program on climate risk and sustainable finance in May 2023 for banking and finance professionals in India. Such capacity building initiatives are a good beginning and needs to be further scaled up for the financial sector to meet the challenges posed by climate risk. A question often asked is that so far international standard setters seem to be focusing primarily on Pillar 2 supervision and Pillar 3 disclosure issues, and whether this is the right focus. Should we not focus on the development of the more prescriptive Pillar 1? In my opinion, the standard setting bodies are rightly focusing on Pillars 2 and 3 at present as compared to Pillar 1. The question that arises is why this emphasis initially on Pillar 3, that is disclosures. The reason is that this gives regulated entities the ability to learn from each other and thus say the position arising out of any risk element erroneously not taken into account by a regulated entity is rectified when it observes its peers disclosing that particular risk element as part of its disclosures. Thus, there is proper identification of all climate-related risks by the regulated entities and a consensus builds on what constitutes the universe of climate-related risks that have to be taken into account. This in turn provides for regulatory and supervisory frameworks and tools to be developed and uniformly applied to all the regulated entities. In the overall analysis, it leads to financial stability, a key mandate of central banks. Once disclosures are robust, regulated entities can then analyze the climate-related risks on their books on account of physical and transition risks. Based on scenario analysis, stress tests can then be conducted by them on their portfolios to assess the hit on their balance sheets in the event of various scenarios considered by them materializing. Supervisors then, as part of the supervisory processes, assess whether the REs have done a fair assessment of the risks on their books. If they feel that a regulated entity does not have adequate capital vis-à-vis the exposure to climate risk, an appropriate Pillar 2 capital requirement might then be applied to ensure that it remains resilient, even in the event of various climate-related risk scenarios unfolding. At this stage, however, the emphasis is on understanding the climate-related financial risks that banks are carrying on their balance sheets and to quantify the same. Once Pillar 2 and 3 are in place, it would then be appropriate to focus on the development of the more prescriptive regulation of Pillar 1. At this juncture, it is not very clear as to whether climate risk is a risk in itself or it is embedded in various other risks like credit risk, market risk, etc. Various standard setting bodies like BCBS and FSB are currently deliberating on it, and the jury is still out. The general opinion is that climate risk is not a new risk type, but a transverse risk that manifests itself through existing risk types. We have to wait for consensus to emerge here. But the key aspect that has to be kept in mind is that capital prescription is a broad brush approach. A not well thought out and focused additional capital requirement would end up constraining banks' ability to intermediate effectively. Further, capital adequacy based on historical default data does not capture systemic risks from certain asset types. For example, properties in flood-prone areas, agricultural loans under extreme weather, etc. There is a school of thought that feels that it may be more advantageous to prescribe macroprudential tools to address systemic risks that may not be addressed fully by the current measures. For instance, the loan-to-value limits on certain sectors that are more sensitive to climate-related risks. Second, amended large exposure limits, which could address sectoral concentrations, that is, lending to several potentially unrelated firms in the same sector of activity. This would address transition risks. The LEF limits could then be put in place to address geographical concentrations too, which would address physical risk. A climate capital buffer akin to the counter-cyclical capital buffer as it exists today, linked to a carbon-intensive credit to GDP ratio could also be considered. And this buffer would decrease as banks reduce their carbon-intensive exposure and increase if the ratio exceeds a pre-specified threshold. However, it needs to be recognized that there are trade-offs while using macroprudential tools. With regard to LTV ratios, restricting residential and commercial real estate lending to climate vulnerable areas may also unwittingly restrict lending to the most disadvantaged communities located in these areas. On LEF limits, restricting lending to carbon intensive industries could have an unintended impact on the value chain that might not be fully understood as of now. A standard setting body would therefore have to be very cognizant of these trade-offs while recommending a course of action to the regulators worldwide. I will conclude here. I wish you all insightful deliberations ahead in this event. Thank you. You're on mute, Neha.
I've unmuted myself. Thank you, Mr. Sinha. That was a very, very important message with very fine details, as you posited out for our panel discussion today. But also, as Rathin said, congratulations on the report, which spells out, a wide range of policies and programs that we need to consider if we want to manage climate change. And as you mentioned, the trade-offs will be very, very clear. They will become apparent as the status quo becomes untenable, and there are simultaneous and just yet differing impacts across sectors, across even spatially and temporally. Our next speaker is Mr. Ricardo Harris. He's the head of regulation in the Deputy Governor's Office at the Central Bank of Brazil. And among his responsibilities is to steer regulatory initiatives related to sustainability portfolio of the bank. Fittingly, he follows you as Brazil is also the incoming G20 presidency. But he is not he's not here with us in an interactive session that we are holding today, primarily because of the difference in the time zone. So he's asked me particularly to convey that he can't be with us, but he is really wishing us a very insightful discussion. And I request now Oliver to play his recorded message that he so gratefully accepted to share with us.
Hello, everyone. I would like to start by thanking the Climate Bond Initiative and the other organizers for inviting me to share with you the Central Banks of Brazil perspective to the sustainability agenda and the challenges imposed by climate change. The Central Bank of Brazil boasts an extensive track record of sustainability-related measures and is widely recognized as one of the most proactive central banks in this field. Indeed, we have consistently maintained a pioneering stance concerning the integration of ESG aspects within the Brazilian financial system. Since 2008, the Central Bank of Brazil has been launching a set of initiatives to respond to the growing needs to address environmental risks and concerns. We have, for example, issued regulation related to the granting of rural credits in the Amazon biome, which prevented the credit to be granted when the borrower is not compliant with the environmental rules in place. Some may question the rationale behind the increasing prioritization of climate change by central banks worldwide in recent years. This trend stems from the fact that climate change harbors substantial implications for the fundamental mandates of central banks, namely ensuring price stability and financial stability. Regarding price stability, it is indisputable that climate change has exerted a significant influence on economic variables within the relevant horizon for monetary policy, thereby impacting foods and energy prices, for instance. In other words, climate change leaves us more vulnerable to more frequent macroeconomic shocks. Climate change is also an important source of financial risk. There are many instances in which climatic shocks can adversely affect specific sectors of the real economy, such as the real estate and agriculture, thereby generating vulnerabilities for the financial system. Put simply, the central banks that are committed to fulfilling their mandates cannot afford to disregard climate change. We will go through a profound economic structural shift due to climate change, and central banks need to ensure that the financial sector is ready to finance the transition and properly manage the risks involved in this process. In my view, central banks have three pivotal roles to play in this regard. First, raising awareness of potential risks arising from climate change. Second, ensuring that the financial system adequately manages those risks. And finally, improving the transparency of the risks and opportunities arising from this process by reducing information asymmetries and fostering market discipline. The Central Bank of Brazil has indeed acted exactly in this way. On raising awareness, we introduced a new sustainability pillar into our institutional agenda 2 years ago that helped to turn on the yellow lights in the financial system for this topic. On the aspects of properly managing the risks stemming from climate change, we have enhanced the prudential regulation so that financial institutions address those risks quite in the same way they manage other conventional risks in the banking sector, such as credit, market, and operational risks. At this point, it is important to highlight that our risk management framework includes not only the climate dimension, but also the social and environmental risks, encompassing a broader sustainability approach. Particularly for emerging market economies, I firmly believe that discussions surrounding the impacts of climate change cannot be dissociated from social aspects. Climate change is deeply intertwined with global patterns of inequality. The poorest and most vulnerable people will probably bear most of the burden of climate change impacts, despite their minimum contribution to the crisis. As the impacts of climate change rise, millions of vulnerable people will face disproportionate challenges in terms of extreme events, health effects, food and water scarcity, and more. So we have also placed great emphasis on incorporating environmental risks within the risk framework of financial institutions. This stems from the fact that Brazil, as you may already know, is the most biologically diverse country in the world, responsible for about 15 to 20% of all existing flora and fauna species. Finally, on the central bank's role of improving transparency, we are incorporating the recommendations of the Task Force on Climate-Related Financial Disclosures, the TCFD, into Brazil's regulatory framework, demanding mandatory disclosure from financial institutions. Once again, we enlarged the scope of the TCFD recommendation to include the social and environmental aspects, considering the importance of these topics in Brazil. Still another initiative related to transparency is what we call the Sustainable Rural Credit Bureau. This is probably one of the most interesting initiatives we are working on, mainly because of its disruptive potential. Agribusiness is a significant component of the Brazilian economy and an important source of its exports. At the same time, a substantial proportion of the country's greenhouse gas emissions is directly or indirectly linked to this economic sector. Agribusiness produced roughly 20% of Brazil's GDP last year and employed nearly 1/3 of the Brazilian workforce. We can also notice that agribusiness was responsible for over 70% of country's emission. So an important question arises. How can the central bank contribute to foster greener agriculture financing? So let me start to explain what we are doing. Today, we have a system in place at the Central Bank of Brazil in which all credit loans granted by banks are required to be recorded. Banks' registration of transactions within the system is a prerequisite for the disbursement of funds to the producer. So we are in the process of transforming this system into a sustainable rural credit bureau. This system is far more advanced than the conventional credit registry system because it encompasses a wealth of information beyond the standard credit financial data. It has detailed technical information, including specifics about the cultivated crops, adopted techniques and practices, potential utilization of renewable energy sources, and most notably, the precise geodetic coordinates of the financed property. Now, we are currently developing new data fields within the system to capture sustainable rural credit characteristics and, at the same time, integrating it to other public databases housed across different governmental agencies, including, for instance, high-resolution satellite imagery. This will enable us to access the compliance of these credit operations with the environmental legislation in place, as well with other sustainable issues. In other words, the system can prevent, in real time and before any money is delivered to the producers, banks from financing projects that, for instance, overlapped protected or embargoed areas, or are located in indigenous lands or federal preservation units, among other existing restrictions. The second important feature of the Bureau, and one that is directly linked to the issue of diminishing information asymmetries, is that the system follows kind of an open finance philosophy, whereby at the end of the day, the data about the credit operations belong to the debtors. This means that debtors can share their detailed credit information with anyone, other banks, suppliers, potential clients, securitization companies, and even green certification company or an SPO interested in streamlining its due diligence process to issue green bonds. The next step will be to use the system to help identify producers and credit transactions that have sustainable characteristics and potential additionalities, and to develop specific policies to foster them, allowing for better credit conditions and funding options. As I conclude my remarks, I would like to highlight some of the forthcoming challenges we face. The first one would be to keep improving the regulations on the mandatory disclosure requirements I mentioned earlier. In the initial phase, we focused on the more qualitative aspects of the TCFD recommendations. Now, we are working on improving the quantitative elements, specifically the targets and metrics section of the disclosure reports. Our objective is that financial institutions disclosure their scope-free emissions, which correspond to the greenhouse gas emissions arising from their credit portfolios, and doing this in a standardized and comparable manner. Another task entails further enhancing our Sustainable Credit Bureau by incorporating new databases and refining the utilization of satellite imagery and artificial intelligence. Through these efforts, we hope to contribute to the increasingly sustainable nature of the rural credits in Brazil. Lastly, I think we will continue to work on refining our tools to accurately capture the impact of climate risk on the financial system. As climate risk is an unprecedented threat, accurately capturing its impacts on banks' balance sheets poses a major challenge and demands innovation in forward-looking modeling and more granular data. These are challenges that every central bank and supervisor will struggle with in the coming years. So building a robust capacity to develop new skills, including non-traditional disciplines, will be imperative in comprehending transmission channels, generating new data sets, customizing scenarios, and refining methodologies to measure the impacts of climate change on the financial system. I firmly believe that fostering a robust dialogue and collaboration among authorities and jurisdictions will be key for fast improvement on this field. To conclude, I would like to express my gratitude to the Climate Bond Initiative for its invaluable contribution in our capacity development. Since 2020, the Climate Bond Initiative, with whom we signed an MOU, has been an important partner supporting our team in capacity building on climate-related issues and on the development of some of the initiatives I mentioned before. So I will stop here. Thank you all for your attention. Bye-bye.
Thank you, Ricardo. If you were here, we would have said it and you would have responded, but thanks a lot for this message. And so now the two messages are over, but they have set the tone perfectly for us to get into the panel discussion. We have ahead of us on our left to deep dive into some of the questions and issues that both Mr. Sarasena and Mr. Ricardo Harris raised before us. We have, I will just take you through the flow, how we will conduct this session. We have 4 panelists. Our Indonesian Central Bank is here. Then we have Mr. Pramod Rao from SEBI. He is not yet joined. He may be delayed, and we will hope that he will join in time. In case he doesn't join us, then the panelists who are here will get more time to reflect on the questions. And then we have Dr. Thomas, and who is from AFD. And we have Ms. Vibhuti Garg, who is the director of the South Asia from AIFA, which is an energy economics institution. From Bank of Indonesia, we have Dr. Mr. Irman Robinson, who heads the macro prudential department and has an extensive experience in systemic risks, in macroprudential risks, etc. Before I get into the discussion itself, I thought it would also be fruitful for me to paraphrase a little bit what I heard and put a few questions before us. So to paraphrase what Mr. Sorosena was saying and what Ricardo also highlighted is that central banks, of course, they have sort of three kind of tools to address climate-related financial risks. One is through prudential policy, which basically means that the mitigating strategies of mitigating financial risk associated with climate change through these policy mechanisms. The second is the monetary policy tool, which basically revolves around maintaining price stability. And in the context of climate change, it means that maintaining price stability despite climate shocks and stresses. And the third aspect that Ratan in the beginning of the conversation highlighted is it is improving the access to finance for green assets and activities. So this means that while you are preparing yourself and the financial entities, as well as the financial system itself against these exogenous shocks, you also have to release and unleash various sources of financing from banks to the real economy sector, so that shift can be made. So again, going back to what Mr. Sinha expressed, there will be simultaneous and differing sectoral impacts. This is also something that came very clearly through Ricardo's address as well. And these differing sectoral impacts, I would say, they could reduce profitability of firms, in turn putting pressure on banks' portfolios and increasing the share of industry bad loans. And they can also exacerbate inflationary pressures and adversely impinge on labor participation. Any of these shocks, they will require careful recalibration and careful reallocation of capital. At the same time, as I said, we will need financial resources at an unprecedented scale and space to flow to the sectors and to the activities credibly. So central banks, they are looking at their core functions and recalibrating those functions around price stability, financial sector stability, exchange rate stability, and economic growth. And if I were to just add to it and what's happening currently, the high level of interest rates that we are observing, which is to bring down inflation, the monetary policy tightening, as we call it, you can argue that it can slow down the pace of decarbonization as cost of capital increases, and it reduces the borrowing for large-scale capital investments in renewable energy. But Ratan, you might even want to weigh in on this later on in the discussion. At a structural level, I think prolonged high inflation, it could hurt investments more fundamentally by distorting price signals and increasing uncertainty. So price stability, which is the core function of central banks, it would remain thus as an essential precondition for green transition to sustain and thrive. So in this panel discussion, where we're basically saying that asking these questions to ourselves, to our panelists, that how can regulators help navigate and accelerate the green transition? I will open the panel discussion by inviting Mr. Irman Robinson to reflect upon it now that India, the current presidency, Brazil, the forthcoming presidency, and yourself, the past presidency of the G20. So it's just very fitting to start with you that in the light of what is happening in ASEAN and also the more regional approach that you have been taking to sustainable finance issues, I would request you to tell us how is Bank Indonesia approaching climate risks and harnessing sustainable finance opportunities, and how do you really plan to use different levers in your policy toolkit for what we can say a regulatory realignment that is required? And do you really think that there are certain things which are different for an emerging market central bank like yourself? So I would really invite you to start us off with certain reflections. Thank you.
Thank you, Neha. Let me begin these discussions by thanking Climate Bond Initiatives, CBI, and also Overseas Development Institute, ODI, as well as Reserve Bank of India that have arranged these discussions very well. So good morning, good day to you all, and good afternoon to you all. On your questions about what we have done in Bank of Indonesia and what we will do in terms of climate risk and also the opportunities, I think we concur that there are broadly at least two aspects relating to climate change, which concern the financial regulators and supervisors. The first, like you said, is also the risk posed to the financial sector. And the second is, of course, the opportunities to escalate sustainable finance and investment. And on both aspects, we in Bank Indonesia view that the ASEAN has made valuable signs of progress. The ASEAN economies have shown a concern and take into account climate-related risk in financial stability assessment. And this is shown by scenario analysis and climate-related stress tests undertaken by various financial regulators in the region. And some countries have also developed principles to guide financial institutions in incorporating climate risk analysis and management. So I think on this aspect, we are very similar with what our colleagues in Brazil do, and also in Reserve Bank of India. And accordingly, to harness the opportunities and attract sustainable investment, ASEAN has also made commendable development. ASEAN Taxonomy Board has developed a regional principle-based taxonomy as common building block to foster sustainable finance in ASEAN member states. And in concordance, most financial regulators in ASEAN regions have developed green, or we call it the sustainable taxonomy, on the national level. Authorities in ASEAN have also strengthened directives or regulations on information disclosure to prevent greenwashing, and also provided regulations or guidance on the issuance of green bonds, including Sharia bonds, or we call it Sukuk. On this take, and regarding the aim of achieving Indonesia's NDC, Bank of Indonesia has put forward multifaceted efforts on escalating sustainable finance in Indonesia. And in doing so, we also align our policy support with the FSB climate roadmap of 4 main elements that covers. The first one is supporting firm level disclosure. And we do this by developing a carbon calculator. We are still developing it to support firms in measuring carbon emissions. And the second one, strengthening data availability by enhancing our integrated bank reporting system, which is planned to capture the emission data and green taxonomy-based loans. And third one, undertaking vulnerability analysis by focusing on assessing transition risk in selected, or we call it priority sectors in Indonesia. And lastly, developing supervisory and regulatory framework, including through formulation of green macroprudential incentives. Now we have policy like adjusting our loan-to-value ratio and reducing reserve requirement for banks that lend or expand their lending to green properties and also for electric vehicle. And we also have policy to support development of green MSMEs. As you see, while some of our green policies, such as differentiated LTV and reserve requirement to support green loans, are in line with the global policies, our policy toolkit is unique compared to the other economies. Of course, this will depend on the condition of each countries. Our macroprudential inclusive financing ratio, carbon calculator, like I have mentioned before, integrated bank reporting system, and green taxonomy, we have developed this and designed this according to Indonesia's economy. And like you also noted that I think the other speakers also mentioned that the green transition is not only the central bank's issues. This is a massive one that needs collaborations with the other authorities. And we are keep trying to strengthen coordination among authorities. We note that the cost-cutting issues and different mandates within each authority, we need to also to fulfill that. We further harness international collaboration and participate actively in international forum on sustainable finance, including in G20 meeting, to ensure that we are kept updated on the frontier development. I will stop here and back to you, Neha.
Thank you, Mr. Robinson. Ratin, I'm handing it over to you.
Yes, thank you. That was a very interesting I think the first time I've had the privilege of listening to 3 central banks from emerging economies providing a perspective on what they're doing. And it is quite different, I assure you, from the rather pleasanter and more stable climes of Threadneedle Street here in London or Paris, where they have the luxury of being steady state economies and therefore focusing on climate without so much worrying about growth. But we are all in a development transition, and we have to manage the climate transition in that development transition. So thank you very much, Pak Robinson, because that was very, very informative for me. It's quite interesting that I think it was the Bali summit that first brought the entire macroeconomic issue of climate risk and transition to the fore for us in the emerging economies. It's one thing for Germany to be talking about it. It's quite another thing when Indonesia tells you why you should pay attention. And I think you brought it out brilliantly, and thank you very much. So now I'd like to turn, please, to Thomas Melonio, who is the Executive Director for AFD, Agence France Développement, for strategy and research, with experience previously in the South African and Mexican central bank. So more G20 here, which is excellent. I was wondering, how does one, AFD, what is it? It's a development bank. It has a very strong research, vertical, which we benefit from. So in looking at sort of your multifaceted engagement, how do you work with governments, central banks, regulators to two things. First, to measure climate-related risks, and second, to sort of foster the development of sustainable finance? It'd be great if you could tell us this with some examples from your own experience.
Yeah, thank you so much, Ratin. Maybe just I'd like to rebound on one of the remarks that Soransina just made earlier on. He said that fundamentally the missions of regulators are not changing, meaning that price stability, financial stability are still there. They might be also have to contribute to other objectives like growth in the US, the general objectives of the Union in the European Union, but still the mission are not necessarily impacted. However, he said, and I really share that past is not a good predictor, and hence climate risk need to be dealt with in a different manner. Hence, my presence here as a director for research, because the identification, measurement, and monitoring of risk will be different. So as you were saying, Ratin, AFD actually lends money to governments, so we are, and to private and public actors who are interested in knowing the risk carried out by these actors and partners. So that's on benefit. Plus, as you are mentioning, we're a government agency and we have country-to-country cooperation to increase and improve as a global public good the monitoring of climate risk worldwide. So it's for on benefit, but it's also a general and worldwide cooperation. Maybe to name just two or three examples. One project we led with the French Central Bank, Banque de France, was to identify amongst the assets held by banks in France, those that are exposed to climate change. And we are currently finishing a similar project with the South African Reserve Board, with, I guess, a very similar, if not identical concern, and very similar to what Irma and Robinson just said, which is for a regulator to identify where the risks are. And commercial banks are not necessarily well equipped to know exactly what the climate model of the country or the national trajectory of the country means for their own portfolio. Identifying risk related to agriculture, it's been said in the case of Brazil, access to water, very important in France and in South Africa as well. This may be identified by the governments, by the regulators, but maybe less so by the commercial banks. So I think it's one important role for regulators to actually provide scenarios at the national level, but also they might be more aware or familiar with global scenarios, typically, to name just one, in the case of South Africa, an important coal exporter, the international demand for coal might not be very well known by domestic actors. That's an international topic, and it's going to depend on demand in India, in China, Indonesia, Vietnam, I mean, on the demand or supply side. So I think it's very important for regulators to be able to provide climate scenarios, and that's really very different from what we had in the past, plus some international macro scenarios that domestic actors are not well equipped to deal with. Just to give you two figures to finalize this answer, in France, we have identified that roughly a bit more than 40% of assets held by banks are exposed to either transition risk or physical risk. And in South Africa, we have identified that 24% of GDP also is exposed to nature-related risk. It's mostly access to surface water and underground water for agriculture plus mining, which is very important in South Africa. But of course, regulators can provide these scenarios that are very useful for their domestic financial system, very much in line with their mandate to maintain financial stability. So just to name these two examples, there are some macro projects, but I'll speak about that later maybe.
Great, thank you, Thomas. This is very interesting, and I'm so glad early on you did bring up, one of my complaints about this entire climate business has been this sort of monofocus on decarbonization and the form of energy used. And I think it's very important, especially in emerging economies, to relate these things to people's lives. And you can't do that if you don't talk about the sectors they work in, like agriculture, like the built environment. So it's good that AFT is doing this. You've been actually quite pioneering in this, sort of trying to move into sectors rather than look at sources. But energy remains fundamentally the spearhead of decarbonization. And I'm so happy, therefore, we have, Vibhuti here with us. Thank you, Vibhuti, for joining. So, drawing on experiences that you've observed researching, let's say, relatively developed markets and others, what strategies do you think central bankers in the global south can employ that can actually do what is easier done in a developed country, which is flow domestic and international capital into low carbon sectors? There's a momentum happening in developed countries, but in developing countries, in emerging economies, the jury is out. So what would you say to our central bankers and finance ministries? How should they do this consistent with, our common goal of decarbonization?
Great. Thanks for having me here, first of all. And responding to your question, you already have heard from the three central banks what needs to be done. So I think there is enough recognition, but just at the cost of not reiterating some of the points, but re-emphasizing that, globally, central banks and financial regulators, as I said, have recognized the importance of addressing climate change. And we are increasingly seeing that in order to address these risks, and they are coming up with prudential approaches. So we have seen several central banks introducing mechanisms, especially the likes of, when we talk about the developed world, the European Central Bank, the US Federal Reserve, the Banque de France and the Bank of England have all undertaken or are planning to undertake stress test exercises, either at a system level or even at a bank level. We have seen RBI, Mr. Sinha did mention, came up with a discussion paper on climate risk and sustainable finance, which primarily provided guidance for regulated entities to, have appropriate governance, which is very important, as well as strategy and risk management structures to manage climate risk, and explore, forward-looking stress testing and climate scenario analysis tools, which can work on enhanced climate disclosure and capacity building exercise. I think these were the two things which came out in all the central bank, remarks when they were talking about the role they are playing and are considering as well. But apart from that, some other mechanisms that one can look at for mobilizing both domestic and international foreign capital is is the use of green debt as collateral that can help build, the market for such securities in kind of developing nations, especially. We, again, to cite few examples, European Central Bank as well as People's Bank of China do accept green debt as eligible collateral while, accessing the liquidity facilities. Apart from that, the Bank of China also has a carbon emission reduction facility, which again provides discounted central bank credit for lending to enterprises working on carbon emission reduction. India RBI also designated sovereign green bonds can now be accepted as collateral as part of maintaining the statutory liquidity ratio. So these are some of the mechanisms, again, which can play a big role. Climate related disclosures, don't want to get into too much details, already spoken a lot, how critical it is to have a disclosure at the entity level on how much exposure they have. So that again, we have already seen G7 and China, which have mandatory there is disclosure that they are undertaking. But more and more countries, and especially the emerging economies, if they can come up with more stricter climate-related disclosures requirements, that would be great. Another one, green taxonomy, spoken again a lot, but there are still countries which don't have a formal green taxonomy. So in the absence of that, a green debt issuance framework, again, that's something which India is also have undertaken, in the sense that RBI came up with the green bond framework, but SEBI, on the other hand, also has its own definition. So there needs to be some synchronization of what is included, what is not included, which provides a proper definition and can help in avoiding any greenwashing going forward. So having a proper taxonomy can also work well. And lastly, I would say use of foreign exchange reserves. Lot of countries are sitting on pile of foreign exchange reserve. If some of that can be attributed for climate change mitigation and adaptation purposes, I think that can again play a big role, can help in unlocking more and more capital into this space. Again, Sweden, Riksbank has allocated climate risk weightages to a section of their fund of the foreign exchange reserves. And similarly, we are seeing Alberta in Canada, as well as in Australia and Queensland in Australia, they are using some of the foreign exchange reserves for addressing climate risk. So these are some other ways, which can become better tools in kind of mitigating climate risk and bringing in more and more domestic as well as foreign capital.
You muted.
That's very interesting, and particularly your last point I can't resist commenting on. Of course, unfortunately for countries like India, which run a structural balance of payments deficit, we can't use those because they're not really our reserves. They're FDI and FII, piling up in the central bank in exchange for rupees. But of course, with countries that are running a foreign exchange surplus, you mentioned Alberta, the oil-producing state, it's a very good use of the money. I wanted to just clarify something Neha said earlier, because I'm trying to move into something. I'm a macroeconomist, so I'm going to ask Thomas a question in a minute, because I'm really curious about how all this fits in with the macroeconomy. But, earlier this question came up of interest rates rising and therefore making it more costly to fund green. The economic theory that says that raising interest rates may reduce inflation is itself under attack. Let me say, I don't think central banks know what's going on anymore. But if you take that orthodox theory, then it's all fine, because basically when you raise interest rates, the economic activity goes down. And that's what you're trying to do. And when economic activity goes down, your carbon emissions go down. So it's not pro-cyclical in that sense. But that's only the theory. Anyway, so I was listening to both, Park Robinson and to Vibhuti, and I realized that actually the architecture for prudential safeguarding of the stability function of the macroeconomy seems to be evolving quite nicely. But for countries for any country, but particularly for countries like India or Indonesia, we have to confront the fact that we are making a development transition And there is a climate transition happening, which is going to be hopefully complementary to and not competitive with the development transition. Which means I would need some sort of a macro transition framework, that includes green, but also talks about transitions in people's lives, speaks of inequality, etc. So Thomas, have you come across this? Have you worked in these spaces? What insights can you bring to us?
Yeah, thank you so much, Ratin. I love the question, so I'll be happy to try to answer it. No, of course, earlier on, we spoke about how regulators have to monitor individual commercial banks and the differences in monitoring now and before. But of course, there are some more long-term macro risk. Maybe I was just a few days ago in India. When you have a long-term pathway to net zero, for example, you'll have to manage an increase in public investment, for example. But I think this requires very different macro from that of the past. If you like DSG model, for example, typically you assume that investment will be financed sort of automatically by savings and that you will have an equilibrium on the interest rate. But you know that in particular in many emerging economies, you rely on international currencies, and the impact of your investment on your debt in foreign currencies plus in domestic currency, that's not a neutral debate. If you borrow more in international currency, it's going to impact your reserves and probably drive up the interest rate. Let me give you two examples. For example, recently we had discussion with Mexico and Colombia. They are strong oil exporters, and they want over the long term to diminish these exports. But of course, it's a very important source of not only public revenues, but also reserves. So they have to diversify and find other sectors which are going not only to create jobs, that's not necessarily the main topic because oil does not create that many jobs, but in terms of public receipts, plus foreign exchange reserves, there you have a major impact. And the problem is that if they don't manage to substitute and find other sources, their currency is going to drop and inflation will come up. So in these two, when you're a commodity exporter, this is the sort of risk that you have to manage over a 20, 30, 40 years period. Very different probably in India, which is importing oil and I think 20% of coal for domestic power production. There, if you are able to substitute domestic power production, well, then in that case, you're going to add up reserves and not diminish your reserve. Hence, it might be way more relevant. So it means you have to look at the sectoral level. If you're able to finance typically renewables instead of import part of your coal, for example, that's not normally a very beneficial swap if you manage to do that, but you have to measure the impact on debt in international currencies, interest rates, which is why we have developed what we call at AFD stock flow consistent model, whereby investment is not like spontaneously financed, and quite the contrary, you have to exactly determine how the management of your debt over the long term and the impact on the various other financial variables. If you finance everything domestically, let's say you have 500 gigawatts of renewables to finance, to take Indian's case, it may have a crowding out effect on the domestic financial sector, or at least you have to make sure that it is not happening and does not have a spillover effect on other sectors. So just my point is to say, of course, there are some very long-term trajectories, and at AFD, we take the government's trajectory for granted, but the sort of technical cooperation we can set up is to try to measure the impact of financial choices to actually have in mirror of the more sectoral government trajectory, all the financial aspects, and not take financing for granted or believing that it has no impact, because it's going to have an impact. And actually, the more your currency is dependent on foreign exchange markets or international borrowing, then the more you have to take that into account. So again, we're very happy to have some technical cooperation with government on this more long-term aspect, with again macro modeling that is different from that you do when you're just on a more short-term projection and trying to manage, I'd say, business as usual. Thank you, Rati.
Yeah.
Perhaps you could arrange, Neha, a meeting with the AFD and our chief economic advisor. I think he would find this of great interest. The stock flow model is quite interesting. It comes from a rather non-mainstream tradition in economics, which I completely support. Godley and Malevon, who's from France. So what you're saying about the unintended consequences, I have been trying to tell my very well-meaning environmental economist friends that this also happens in fiscal policy. So, in country after country, India is a good example. We tax fossil fuels, and I myself have been instrumental in framing that strategy. You tax petrol and don't worry about the middle class. I did a study on mall footfalls 3 years ago in Delhi and Bangalore, and it showed petrol price goes up, people scream, but there's no change in mall footfalls. Same amount of cars go to the malls. These guys can afford it. The problem is when the elasticity of demand is so low, that demand is so inelastic, then the revenues you get from raising taxes on petroleum become so high that when actually people start consuming less fossil fuels, it affects the budget and the fisc, and then you panic. And this has happened with cigarettes in Australia. This has happened with alcohol in India, and now it's happening with petrol. So there are many things we have to take into account when we sort of craft a transition policy. It's not just about jobs as people frame it in countries like the UK. So then over to you, Neha.
Yeah, thank you. Thank you, Thomas, and thank you, Ratan, for delving deeper into the macroeconomic part of it, because it's extremely important. One thing is pretty clear, right? That this transition is not going to be straightforward, not going to be linear. It will probably be quite expensive, and we have to manage it in a way that it is orderly, right? So the kind of revenue losses that we will have in certain sectors may not be sufficiently substituted by the gains in taxes in other, say, renewable sectors. So what we are actually facing, I think, especially in developing countries like India, is that a majority of our budgetary receipts are actually locked into fossil fuel consumption. So to shift, to make that transition in an orderly manner, they will be required a very, very deft management and use of tools like monetary policy and fiscal policy, and turning our attention to fiscal policy, because the gap in financing is so huge. I don't think that we can take our eyes off fiscal policy aspects as well, which also comes across very strongly in the report that the Reserve Bank of India has just published, that somewhere central banks will have to play the supplemental role, and ministries of finance will have to take a much a leading role in making those adjustments, those financial policy innovations. And I will turn to you, Mr. Robinson, on this account. And you mentioned that you are also coordinating your efforts with other entities within the financial system, particularly Ministry of Finance, and looking at the role of fiscal policy as well in Indonesia. Could you please tell us a little bit more about that on a broad level, as well as say also specifically comment upon how certain frameworks that you are as a central bank trying to institute within the policy toolkit that you are employing, and how do that complement or supplement what the Ministry of Finance in Indonesia is doing?
Thank you, Neha, and also thank you, Dr. Roy. I think talking about financing side or financing aspect of green transition is always an interesting topic. This is quite a challenge for every country, I think. And it is true that, financing gap for transition is quite big. For Indonesia itself, the Ministry of Environment and Forestry, one of the ministries in Indonesia, once estimated that we need at least around $281 billion for mitigation and also adaptation actions to achieve our NDC target. So the source of financings, of course, can be borne only by the fiscal budget. I agree with that, but also need active participation from the private sectors, maybe including also the foreign financing from abroad. And from fiscal perspective, I'm coming from central bank, but I can give you a big picture about it. So aside from the budget allocation for development and resharing of renewable energy projects, now we have there have been strong initiatives to promote blended finance. So the Minister of Finance has assigned a special mission vehicle, what we call PT Sarana Multigria Infrastructure, or we call it PTSMI, to spearhead a blended finance platform that we call SDG Indonesia 1. This is the name of the fund, SDG Indonesia 1. And PTSMI acts as a country platform to nurture and enhance bilateral and multilateral source of transition financing. Ministry of Finance has established as well the Indonesia Environment Fund, what we call BP DLH, is Indonesian language. Sorry, I cannot spell it to you. So this is a special public service bureau to manage environment fund. And further, in addition to that, Indonesia's fiscal authority also implement budget tagging on spending related to sustainable projects and actively issues green sukuk or SDG bond. And the government also look forward to apply carbon tax, but this will be implemented gradually, with the first implementation still on the pipeline. Will start it at 2025. And meanwhile, the government have implemented carbon trading for coal-based power plants in attempt to reduce greenhouse gas emissions from the energy sector. Aside of fiscal authority, I can also mention, if you allow me to mention about what the other authorities, financial authorities in Indonesia, because a part of central bank, we also have Indonesian FSA or OJK, which also support the development of sustainable finance through various initiatives, notably the establishment of Indonesia Green Taxonomy. We call it version 1.0 at this time, and regulation on green bond issuance, as well as regulation on sustainability disclosure for public companies and financial institutions. We note that these developments, the financial regulators in Indonesia have considered sustainability aspect in our policies and also initiatives. And to strengthen the regulatory framework, in January 2023, this year actually, early this year, Indonesia, or we just issued what we call Omnibus Law on developing and strengthening the financial sector, that give a new mandate for the three financial authorities to regulate on sustainable finance. So the law stated that the three authorities, the Ministry of Finance, Bank of Indonesia, and also Indonesian FSA, take a different role, but we align with an aligned mandate, of course. For instance, like Bank Indonesia is to develop and regulate sustainable finance to ensure financial system stability, while the Ministry of Finance is in charge on fiscal initiative mechanism, and the Indonesian FSA or OJK develops carbon exchange and also promotes capital market instruments related to sustainable finance. And regarding your questions about what's the contributions that central bank can contribute to the fiscal, let's say, to the financing of sustainable finance, like I mentioned before, we have issued several macroprudential policies like loan-to-value ratio to promote banks to increase their lending to electric vehicle and also green property. That's the first one. The second one, we also give a kind of incentives by reducing reserve requirement for banks that achieve a certain target of green loan share to the total loan number or amounts. And we also, together with OJK, we also now promote the disclosure requirements for corporates and also financial institutions, because we think that reporting, disclosures of financial statements and transparency of reporting is very important, because of course investors and creditors need these informations that's very transparent for them to be informed which companies they can lend to or they can invest to in regards to green transition or sustainable transitions. I will stop here. Back to you, Neha.
Thank you, Mr. Robinson.
Yes.
Am I turning to you, Ratan, now?
Yes, I think you are, because we have one more question to go. But that was quite interesting. So we have basically three public parties to this contract. We have the central bank, we have regulatory institutions, we have standards agencies, and then of course we have the Ministry of Finance. So here's the final question to the audience, to the panelists. And by the way, participants, you will notice that there's a Q&A box there. It says Q&A. So it's quite easy to find at the bottom of your screen, at least on my screen. And, we will be inviting our participants to respond to those questions as soon as I have asked my final question, and that is to Vibhuti, which is, hearing all this and given your experience, how can sort of international organizations or international networks like the G20, and other international forums, how can they help develop financial regulators' capacities?
Right. So I think platforms like G20 can play an instrumental role in bringing the much needed fiscal and monetary policy reforms, and moreover, building the capacity of the stakeholders, which can enable especially the emerging economies to bring in the much needed investment in building a low carbon economy. So I think clearly there is a need for building capacity. So due to the uniqueness and complexities of climate change, the financial sector regulators globally do not have the capacity and know how to tackle climate risks, either on their portfolios or even with the regulated entities. So, for instance, the forward-looking nature of climate risk, both physical and transition, and the huge uncertainties in projections make running any scenario analysis and stress tests a difficult task. So consequently, we have been seeing that incorporating such risks in financial institutions' risk management framework has been becoming very, very difficult. So we have seen progress being made by the developed financial regulators who have been more in the front runners in building those kind of risks. And if there can be more of exchange of such methodologies, such tools with the emerging economies, and help them capture some of these features, that can be that role G20 can play. Just to cite few examples, we already have the National Green Financing System, the NGFS, which has more than 114 central banks and the financial supervisors, which are part of that system. So if there can be more exchange under the NGFS, I think the G20, through its contacts with the finance ministers and central bank governor meetings, can help more and more collaboration between the different countries on this. Similarly, the BIS, the Bank of International Settlements, led Basel Committee on Banking Supervision, which is again another primary standard setter for the prudential regulations, can play that kind of a role. So these are some of the already existing mechanisms, existing institutions which have a lot of banks from so many different countries already part of the system. So we should be using those systems more effectively in exchange of that. And definitely the G20's International Financial Architecture Working Group and the Sustainable Finance Working Group can really make that happen in a much more seamless manner. Greater coordination at the international level can help really build those kind of mechanisms more easily. And we also spoke about the TCFD, while different countries may have different mechanisms, but just to bring in much more consistency across different countries, the TCFD framework implementation throughout different countries can also help in better disclosure mechanisms in place. And that can really help in easing the international capital to flow in any part of the world because of their understanding of those systems. Otherwise, when we have individual countries having their own set of system, it becomes very, very cumbersome, and that delays the whole thing of putting in more and more investment into different countries. So I think having a more standardized system can really, again, be one of the things which the G20 should be looking at.
Thank you. Neha, over to you.
Yeah, thank you, Ratin. In fact, just to add to what Vibhuti has said, that the Indian presidency of G20 now has released an input paper on building capacities per se, and they have what they call a sustainable finance technical assistance and action plan. So it is on that platform that they're seeking a lot of suggestions from all the countries on what can be done to build capacities and also to coordinate better on sustainable financial issues, which will help augment the flows of finance from global north to global south. But also we have a couple of questions which I thought that we could share with our panelists. And the one question, it is a very simple, it's a short question, but I think it is important one. It is by Asim Sharma, and he is asking, and I would give it to either Ratan or Thomas to answer. Maybe Thomas first. What is the correlation between climate risk and inflation and interest rates? It's a basic question, right? And I think it is a good one, so I picked it up.
Thank you, Nia. Maybe just to rebound on the capacity building debate. Yes. Also, I wanted to mention that there's also cooperation between development banks, typically the ones that will emit grid bonds at the end of the day. So we have our brothers and colleagues at PTSMI in Indonesia, but same in China with CDB, Brazil with BNDES, or CDB in India. Just to state that, of course, regulators will, at the end of ultimately design the regulation, but sometimes their public national development banks will be the first one to emit a green bond or to help create the market. It's been happening in many places. Also have an example in South Africa. So it's also this kind of cooperation between financial institutions is also a way to promote sustainable finance from the perspective of development bank. So just wanted to state that, but I know that the Bank of Indonesia has already quoted the PTSMI, but these are our counterparts. Maybe on that question, well, at least for Europe, but it is the same in a few emerging countries on which I worked, but it's clear that there's rather an inflationary effect of climate change. I think it's been also said in the case of Brazil, typically because you expect an impact on infrastructure, on agriculture, rather by diminishing returns than increasing returns. Maybe there are a few exceptions here or there, but generally speaking, you need to adapt quickly, maybe change the crops, maybe you can expect soil degradation. In general, increasing heat means higher evaporation of water, which has an impact on agriculture. So for sure, on the agricultural sector, the effect will be rather to diminish a little bit production and therefore to increase prices. And what we observe in Europe is also regarding energy, is when you have to manage the winding down of certain energy industries to accelerate typically renewables or nuclear. Again, you have to close certain plants earlier than expected. So it means that there would be an inflationary effect. We don't know exactly the magnitude, but I think the trend is rather there. So if you look in purely monetary terms, it means probably interest rates will have to be partly adjusted, but again, with this arbitration between growth and inflation. So it's possible that central banks may, over time, slightly change their targets so to accommodate for green transition while limiting the impact of jobs. But that's just a personal opinion. So very short, I don't know if Ratan wants to maybe contradict, I don't know. But I would expect rather an inflationary effect, not huge, but it's what we would model.
No, I would broadly agree with you, except to just add one thing, that climate risk happens. I mean, there are two things that central banks have to look at, right? One is the actual incidence of climate risk. So obviously, when you have incidence of climate risk, what happens is that the net stock of assets in a country goes down, as New York is seeing today with those Canadian fires. And they have spread effects. If your net stock goes down, then your GDP falls. And if your GDP falls, and demand does not fall, because this is an asset destruction, this is not a demand-led recession, then you will have a price rise. So that's the fundamental organizing theory. If I may, Neha, can I take up that question there? I don't think it's fair to anybody else. On implications of the EU's carbon border adjustment mechanism, yes, on India's growth trajectory and 2047. I'm particularly glad that Thomas is here. We are in a very fortunate position, India. Very fortunate. We can just stop doing business with Europe. Because we do not accept, and I think there is bipartisan consensus on this, that anybody has the right to unilaterally fix prices to account for climate. So if there is any expectation from Europe that India is going to respond to the EU's carbon border adjustment mechanism by changing we may change our green configuration and how we produce things for our own reasons, not least for increasing productivity. But we're not going to do it to respond to Europe as a market. And here we're very lucky. Unlike China, we are such bad exporters that we only account for less than 2% of global exports. So you know what? Go ahead with your carbon border adjustment mechanism. We just buy oil from Russia. Sorry, that's a provocative answer. But I do mean that in a sense that if you take in the political economy, then you would be pushing countries and I've been saying this to Europe in particular, not to be Jesuitical about economic policy. Do not put in things that act as barriers to trade. It is not the right way to respond, particularly to large emerging economies. You can probably browbeat poor Malawi because they don't have, that's why I said we are lucky, we are big, we have an option. Yeah, so that is, so on India's growth trajectory, I think there are bigger problems with India's growth trajectory, but those are more domestic. I don't think the Europeans are going to make a bit of a difference.
Thank you, Rathin. Thomas, do you want to weigh in on that?
Well, I'm not a spokesperson for the European Commission, but maybe just to explain why there is this carbon adjustment mechanism in the first place. Well, actually, some have discussed the introduction of carbon taxes, but if you like, the situation in Europe is that there's already a significant taxation of carbon. If I go and take my car and go to buy gas, 80% of the price will be taxes, and it's similar in other ways. So the issue is that currently the taxation system in Europe favors producers outside of the union when they are not taxed at all on carbon. So hence the word on a mechanism to adjust, and not it's not an import tax. It's because although if it doesn't happen, actually it's for European industry. It's more it comes at an advantage to go outside of Europe where there are no carbon taxes than remaining on the domestic market. So again, it's more about having a level playing field in terms of trade. Because there are taxes and relatively, very significant on oil and gas, quite significant on coal, and the price of carbon in Europe is increasing relatively rapidly. It was very low in the 90s and 2000s, but now it's becoming very significant, and we don't want the consumer to choose rather importing goods which are not taxed on carbon, while domestically produced goods are heavily taxed on carbon. And so I think my best guess is that each country, when you are introducing a national carbon tax, of course, you will ask for your imports to pay a similar price on carbon. Otherwise, you favor your imports against your own producers. So I'm not saying you should end up with trade in general, but I'm just saying introduction of domestic taxation has an impact on trade. When you don't have a domestic taxation, well, you don't need a border tax. I mean, at least not for industrial reasons. So that would be my my explanation.
I'll come to Paris and have lunch with you and debate this.
So thank you, and I think there is a separate conversation around that itself, and one could talk about carbon tax, and it is a debatable issue. It has to be high enough, it has to be stable enough to be able to actually be meaningful in any way, and who sets the floor price, so all of those things are important questions, but it is considered as one of those tools that can help reduce carbon emissions, not without its own pros and disadvantages or debatable points. There are actually questions are actually just coming in quite a lot. I will be able to pick up one or two more. We will respond to these questions also offline. And if we can, I see one more question, and I think this is an important one. I will direct it to Mr. Robinson and also to Thomas. The question is, one part was CBAM in the question, the other part was role of regulators in ensuring just transition. So would any one of you like to pick that one out? Role of regulators.
Yes. Maybe I can respond it first, and Thomas will read it, because usually the second speaker will, make it more comprehensively. So regarding this, I just want to bring you all back to G20 last year in Indonesia. We as presidency, and together with all the G20 members, we have, I think we have set recommendations on 3 areas. The first one is to build the green transition framework. The second one is to increase the commitment of financial institutions for the green transition. And the third one is to increase the scaling up the finance, the sustainable finance. So on the first aspect about the green framework, green transition framework, in that one, we have said that each of financial institutions should put on their disclosure, at least their disclosure, and also on the roadmap, how they can mitigate the social economic impact of the green transitions. So this is related to what your questions about just transitions. So, for instance, when they have set their let's say roadmap or a strategic plan for the green transition, they have to think about what is the impact to the workers. What is the impact to the old workers that do not have capacity or skills on the new technology? Will they, put a training for the new technology for the workers, or what will they do with this? This one example that they have to put on the roadmap or the strategic plan for the green transitions, and they have to also put it in disclosure of financial statements. The second one, as a regulator, we also always care about what is the impact of green transition, or more broadly is sustainable transitions, to what we call MSMEs. Mm-hmm. Because of course, when we talk about green transition, we do not want only corporates involved in these transitions. We also want MSMEs to put their contributions in these transitions. This is why I mentioned before in my your first questions that we also have policy to increase or to support the green transition for MSMEs. Because, we know altogether that green transition sometimes need big capital, and, capital usually doesn't relate to MSMEs. So how we can support them? This is one of the, the tasks, the important tasks of regulators to take care of, and also to put in their policy framework. Maybe I will stop here, and maybe Thomas will yes. Also add something. Thank you.
It is, we are coming up on time, but Thomas, would you like to add anything over here, or can we move on? If you have anything to add, most welcome.
No, I just wanted to add that the just nature of the transition is very important. Otherwise, it's not going to happen, or at enormous cost. So, I was just a few minutes ago with colleagues working on South Africa, and I saw maps on where exactly we expect the heaviest social impact of the transition. The mining regions, but also access to water, also I think in KwaZulu-Natal or Eastern Cape. And that's very important for government to be able to well identify where the losers will be, how they can be compensated, and take that question very seriously. And also time management is important. Ratin earlier on talked about elasticities. We had, for example, some measures that failed in France when government tried to increase too rapidly the cost of gas, for example. It can be done over time, but people will need time to adjust, to change their consumption, to maybe find a different job, and it's not going to happen like that. So having a proper management over a longer period sometimes is a way to diminish social cost, which is of course very important. Just saying that.
Thank you so much, everyone. There are fantastic questions in front of me right now, but unfortunately, we'll not be able to take all of them. Just to give you a flavor, there are questions around the role of nuclear energy, that it is coming up, and what role that plays in energy transition, and what does it mean for renewable energy investments. There are questions around the decentralized renewable energy systems, which will also be very, very crucial for resilience. And of course, I think overall, also the role of multilateral institutions, the role of taxonomies. So I think our discussion and the questions themselves over here have really told us that the canvas is large, And the old mandates of our regulators, like central banks, are changing. There are certain tools that are at hand available. And I think the regulators and central bankers in particular will factor in their contextual considerations, which are macroeconomic and financial stability considerations to actually to go forward. But the direction is pretty much set. I don't think there is a reverse gear. I think it is a matter of recalibration and a careful management, rather than saying that, central banks do not have a role to play or regulators do not have a role to play, but more and more going forward, more role to play, and in a progressive role to play. I will conclude by saying that the questions that we haven't been able to answer, we will put them out to our speakers, and I would welcome our speakers to respond to some of those questions. What we heard right now in this session was that we have just begun. The issue of materiality, the issue of proportionality, the concentration of risk, the issue of qualitative and quantitative assessment and management of risk is important on one side. And we have just begun. The models will change, they will get refined, and I would not re-emphasize what has already been said by Mr. Sinha, by Mr. Robinson, and by Ricardo, as well as by others over here. But on the other side, the opportunity is also huge, and I think that opportunity needs to be tapped as well, and unlocking the potential of financial flows from global north to global south through comparable systems, through credible systems like taxonomies will be important, both in attracting larger flows as well as to manage risks. I will conclude by thanking everyone and also giving a shout out to my colleagues and to the partners who have supported bringing up this, putting together this webinar today, especially Andres in Brazil, who got us connected with the Central Bank of Brazil, and my dear colleague CX in Indonesia, without whom we wouldn't have got Mr. Robinson on board. Thank you, partners. Thank you, speakers. Thank you, my co-chair, Ratan. You're always illuminate the discussion provocatively with very thought-provoking questions. And I think all of those questions are also valid as we move ahead. So thank you for everyone's time. I will close the webinar today saying bye to everyone. And thank you so much.
Thank you.
Thank you, Neha. Thank you, Roy. Thank you, Thomas. Thank you,
Rahman.
Carl, Vibhuti, and all the colleagues. Thank you very much.